Imagine owning a piece of a London skyscraper, not just any skyscraper, but one of those iconic landmarks that define the city skyline. Or perhaps a sliver of gold, safely stored in a high-security vault, a tangible asset representing stability and enduring value. These kinds of investments, offering both prestige and security, once seemed exclusively reserved for the ultra-wealthy, the elite few with access to these rarefied opportunities. Traditionally, securing these investments required huge sums of capital, often representing a significant barrier to entry for the average investor. And the process involved endless paperwork, complex legal agreements, and a significant time commitment. It also demanded exclusive connections, access to insider networks, and a deep understanding of the often opaque world of high finance. But now, thanks to the innovative technology behind cryptocurrencies and blockchain, those doors are starting to open for everyone, democratizing access to these previously exclusive investment opportunities. We're talking about making real, tangible assets, from real estate to precious metals, accessible and tradable online, breaking down geographical barriers and streamlining the investment process. This is all done securely and transparently, leveraging the power of blockchain to ensure the integrity and traceability of every transaction. This is a revolution in ownership, a fundamental shift in how we perceive and interact with assets. It's breaking down barriers, empowering individuals, and putting investment power back in your hands, allowing you to participate in markets that were once out of reach. Over the next few minutes, I'll explain exactly how this new system works, demystifying the technology and outlining the key concepts. We'll also discuss what it means for you, the potential benefits, and importantly, the risks you need to be aware of before making any investment decisions. This isn't a sales pitch designed to pressure you into anything, just your essential, unbiased guide to a financial shift that could fundamentally change how we all think about money and investment. So, let's dive in, get informed together, and explore the exciting possibilities that this new era of fractionalized asset ownership offers. So what are real-world assets, or RWAs? Simply put, they're anything of value in the physical world: your house, your car, even a gold watch. These assets are the backbone of our economy, but they're usually hard to buy or sell quickly. Selling a house, for example, takes months and lots of middlemen. This illiquidity locks up wealth and keeps most people out. By bringing RWAs onto the blockchain, we can unlock this value and make trading them as easy as buying shares online. The goal: turn physical things, like a block of flats, into digital assets you can buy and sell in minutes. That's the foundation of this new financial revolution. How do we turn a house into something you can buy online? The answer is tokenization. Tokenization creates digital tokens on a blockchain, each representing a share of a real asset. For example, a £500,000 property could be split into 500,000 tokens, each worth £1. Buy 100 tokens and you own £100 of that property, recorded securely on the blockchain. Smart contract self-executing code handle the rules, like transferring tokens when you pay or distributing rental income automatically. This cuts out middlemen and automates complex processes. Tokens can even include rights to income, making everything transparent and efficient. In short, tokenization turns real-world assets into secure, programmable, and easily tradable digital shares. That's the magic behind the scenes. Let's break down how a physical asset becomes a digital token. First, a company identifies an asset, say a warehouse, and gathers all the details. Next, they set up a legal structure, often using a special company, an SPV, to own the asset. This legal link ensures your token actually represents a real-world share. Then, independent experts value the asset and check all the paperwork. All this info is shared with potential investors for transparency. Tokens are then created on a blockchain, each tied to a share of the asset. Smart contracts define your rights and how income is paid out. Finally, tokens are sold to investors, who can buy them with regular money or crypto. That's how a warehouse becomes a tradable digital investment. So, what's in it for you? Why should you even consider tokenization? It's a fair question. In a world saturated with investment opportunities, understanding the unique advantages of tokenized assets is crucial. First, liquidity. Tokenized assets can be traded 24/7, unlike traditional markets with their fixed opening hours. This means you can react to market changes and manage your investments whenever you need to, regardless of the time of day or your location. This enhanced liquidity means you can cash out in minutes, not months, as is often the case with less liquid assets like real estate or private equity. Second, fractional ownership tokenization breaks down high-value assets into smaller, more affordable pieces. This allows you to invest with small amounts, not huge sums, opening up opportunities that were previously only accessible to wealthy individuals or institutions. This ability to invest in fractions lets you diversify your portfolio like never before, spreading your risk across a wider range of assets and investment types, even with a limited budget. Third, global access. Tokenization transcends geographical boundaries. Anyone, anywhere, can invest in tokenized assets, creating a truly global marketplace. This eliminates many of the barriers to international investment, allowing you to participate in opportunities around the world without the usual cross-border headaches of currency exchange, regulatory compliance, and complex paperwork. Smart contracts automate payments and transfers, ensuring that transactions are executed automatically when predefined conditions are met. This automation streamlines the investment process, slashing costs by cutting out middlemen like brokers, custodians, and other intermediaries who traditionally take a cut. Because of these efficiencies, more of your money goes directly into the investment itself, rather than being eaten up by fees and commissions. And, as a result, more of the returns generated by the investment come back to you, maximizing your potential profits. Finally, transparency. Every transaction and rule governing the tokenized asset is immutably recorded on the blockchain, a public and distributed ledger. This means that the entire history of the asset, from its creation to its current ownership, is readily available for anyone to verify, fostering trust and accountability. No more hidden fees or murky ownership structures that can obscure the true costs and risks of an investment. With tokenization, you see exactly what you own, how it works, and what the associated costs are, empowering you to make informed investment decisions. In short, tokenization offers flexibility, accessibility, and trust, qualities that are increasingly important in today's rapidly evolving financial landscape. These are benefits that traditional finance, with its inherent limitations and legacy systems, often struggles to match. It's a new way to invest, designed for everyone regardless of their wealth or location. But, as always, there's more to the story. Tokenizing real-world assets opens up exciting new possibilities, but it's crucial to understand that this innovative space comes with its own set of challenges. It's not all smooth sailing, and it's important to be aware of the potential pitfalls. Exciting as this sounds, there are real risks involved that you need to consider carefully before diving in. Regulation is a big one. The legal landscape surrounding tokenization is still evolving rapidly across different jurisdictions. The rules are being written as we speak, and what's perfectly legal today could face new restrictions or even become illegal tomorrow. This regulatory uncertainty adds a layer of complexity and risk for investors. Staying informed about the latest regulatory developments is absolutely essential. Smart contracts, while incredibly powerful tools for automating agreements, can also be vulnerable. They are essentially lines of code, and like any software, they can have bugs or security flaws. And unfortunately, hackers have exploited these vulnerabilities before, leading to significant losses for investors. Rigorous auditing and testing of smart contracts are vital to minimize these risks. The value of your token is directly tied to the underlying real-world asset it represents. This means its performance hinges on the asset's actual worth and stability. Therefore, accurate and up-to-date valuations of the underlying asset are absolutely crucial for determining the fair price of the token. Any inaccuracies or delays in valuation can lead to mispricing and potential losses. This brings in the oracle problem, the challenge of reliably and securely feeding real-world data onto the blockchain. If the data feeding the blockchain is inaccurate, manipulated, or simply delayed, the whole system can go awry, leading to incorrect execution of smart contracts and potentially devastating consequences. You're also placing a significant amount of trust in the company or entity that is managing the underlying asset and issuing the tokens. If they fail to properly manage the asset, become insolvent, or even worse, engage in fraudulent activities, your investment is directly at risk. Therefore, it's essential to thoroughly research the team behind the tokenization project, understand their legal structure, and carefully review their security audits before committing any of your capital. These risks are very real, and they are not just theoretical possibilities. They represent tangible challenges that could impact your investment. Never, ever invest money that you cannot afford to lose. Tokenization, like any investment, carries inherent risks, and it's crucial to protect your financial well-being. Caution, thorough research, and diligent risk assessment are absolutely essential as you navigate this new and exciting frontier of tokenized real-world assets. This isn't just theory. Tokenization is already happening. Real estate projects are selling tokens for shares in apartment buildings, letting investors earn rental income and benefit from property appreciation. Gold-backed tokens let you own and trade fractions of physical gold, combining security with digital convenience. Small businesses are raising funds by issuing bond tokens, with smart contracts handling interest payments directly to investors. We're also seeing experiments with art, luxury cars, and even carbon credits. Each case aims to solve the same problems: illiquidity, high entry barriers, and costly intermediaries. While most projects are still small, they prove the concept works. The link between physical and digital assets is real and growing. The possibilities are just beginning to unfold. So, what's next? In 5 or 10 years, tokenized assets could be a normal part of investing. Imagine owning tokens for wind farms, rental properties, or fine wine, all from your phone. This could unlock trillions in value and make markets more dynamic and accessible. Small businesses could raise funds more easily, and investors could build more diverse portfolios. But for this future to happen, we need clear regulations, better technology, and user-friendly platforms. The goal, a financial system where access is based on knowledge, not wealth or connections. Tokenization is a big step toward that future. The journey is just beginning, and the potential is huge. We've covered what real-world assets are, how tokenization works, and both the opportunities and risks. This is a major shift in how we can own and invest in the world around us. The potential is huge, but so are the risks, especially in these early days. Treat any investment here as speculative, not a safe bet for your life savings. Learn before you leap. Research the people, the project, the legal structure, and the technology. Be skeptical if it sounds too good to be true. It probably is. The best investment right now is in your own knowledge. Watch the space, see how it develops, and wait for the industry to mature. The opportunities will still be there when the dust settles. Stay curious, stay cautious, and stay safe.